Hello everybody, this is George Veter from Veter Financial Group, and I'm grateful to spend just a few minutes discussing where we are right now. It's the last day of August in 2020. What's going on in the world economically, what things feel like, and address maybe some concerns and some strategies that might help some of us navigate this interesting moment in time from an investment standpoint. First of all, to kind of frame where we're at, we've been living in a pandemic environment since early spring, and the stock market reacted when we started having government guidelines and protocols in order to stay safe through this pandemic. People got scared, and in March the market dived. It had peaked, and we hit highs in all of the major indices February 10th. And then we hit our lows for the year in a very sharp V pattern March 23rd. And we've been in recovery ever since. Now the NASDAQ, because technology stocks have by far been the favored stocks in this particular environment, the NASDAQ, which is more predominantly representative of technology than the other indices, has exploded back and reached many, many highs and is leading the market forward. But now we have the Dow hitting an all-time high, as well as the S&P has hit an all-time high. So we're at a point now where we're moving into historically the most difficult time of the stock market season, which is September. And if we go back to 1950 to now, September has the lowest average return. So the market has a habit, if it's worried about something, oftentimes September is a weak month where sellers will go ahead and unload positions and the market will get weaker. Lots of times we think October is the most volatile month because there's been many years where October has been the bottom of a V pattern and the market has bottomed from its September mood into the final quarter of the year, which gets very bullish historically on average. So we've got kind of a tough month to go on the calendar historically, and then we have this election that we know is very divisive, very polarized, a lot of feelings about the election and possible outcomes and how that would affect the economy. So I'm having conversations with clients that are very concerned on an ongoing basis about the political environment, economic environment, and a lot of people are kind of nervous and on the edge of their seat. So here's what I would say. Now, when we have worry points in the market like we do right now, and up to this point in time, the market's been climbing what Wall Street calls the wall of worry. You know, we've been worried, but we keep going higher. Worried, but we keep going higher. So is there going to be volatility moving into the election? I really can't tell you. This year has been a pattern that I wouldn't have predicted, so I'm not going to try to be the smartest guy in the room and predict the next few months. But I will tell you, Wall Street hates uncertainty. And so just getting past the election, Wall Street and investors will know what cards they're dealt and they can move forward. But until then, there's going to be speculation, uncertainty, and some doubting, and I think some angst. So if you're bringing me cash right now, if you come and you bring me whatever, $100,000 or $1 million or money that's not invested, I would tell you the safest strategy is going to be to average it into the market over the next few months. Now, I believe we have a 90-day window that history tells us should be the most volatile. So if you brought me, again, a big chunk of cash, uninvested money, I would tell you put a third in now, a third in 30 days, and a third in another 30 days. So by election time, we're invested. Historically, the fourth quarter is the most bullish quarter. Again, since 1950, and using the S&P statistics, December by far is our best average returning month. And we call that the Santa Claus rally that happens, consumer season. And the market typically does great, though not always, but typically does great. It has, as far as bad months and good months over the years, December has by far the best ratio of good months. So we want to be invested typically by December. And then the second best month of the year on average is November, using the same data. The third best month of the year is January. So that rolling quarter, we usually make a lot of our gains. how are the years going to pay out, that's going to be pivotal for us. If it's volatile between now and then, and again, we're not trying to time the market, we're just being cautious for people that have that angsty feeling, then we could layer it into the market. And then if there is a dip in September or October or right at election, if we're dollar cost averaging, or if we're chunking the money in over 90 days, actually a month of volatility to the downside would be profitable to us, right? We would be buying more shares of whatever funds we're buying because the price is cheaper, right? So when you're buying, you want prices to be cheap if possible. When you're selling, you want prices to be high, right? That's one of the laws of economics. Now, dollar cost averaging just says if you're systematically investing, whether it's over 3 months or whether it's over 12 months, if you're systematically investing the same amount each month, then automatically when prices drop, if there's a bad month, that month you're going to buy more shares with the same dollars you spent the month before, and assuming the market recovers, you're going to spend the next month. So dollar cost averaging actually allows you to accumulate more shares when they have those dips. So when I have clients come in and they're giving me money to get invested for them based on their goals, if they're very confident about what's going on right now, then I go ahead and build the portfolio and get them fully invested. Certainly if they already have their money invested and I'm taking over portfolios, or they're existing clients of mine and we're just having conversations about strategy, I'm certainly not going to tell them to go to cash here and dollar cost average. But if you're bringing me money that's in cash and you want to be careful about getting it invested, then we can talk about dollar cost averaging. I look forward to those conversations with those of you that are my clients that have possible additional deposits, because maybe you have too much cash you're sitting on that's certainly not doing very much in the bank, right? The bank's a holding place, not a place to grow your money. And then some of you that are going to be onboarding as new clients that come to us from referrals, we'll be having that conversation about dollar cost averaging. But I wanted to air it out to my entire client base right now so you know what's on my mind and the strategy that we're using to be as safe as we possibly can. So God bless you. Enjoy the balance of your summer. I look forward to our visits, and keep yourself safe.